So welcome to the KPI reporting spreadsheet. I'm just going to run through the tabs that are here. This is a fairly comprehensive spreadsheet that covers things from understanding your cash flow to your budget to making sure that you're on track with your profit, so your projected versus actuals, and even actually a place where you can measure your marketing. So we'll talk about the 5 ways as well. But the very first tab here is what's called the break-even tab. Now the break-even tab is pretty straightforward. What it does is it helps you understand how much money do you need to turn over in your business to break even. So the first thing with this spreadsheet you need to know is that the boxes in blue are for you to adjust and the boxes in yellow are calculated. So what we're going to do here is, if you see a little red triangle at the top of a box, it usually means there's a help tab associated with it. So if you hover over that, it'll tell you to change as necessary. So in here we might say 2016 is the time period, or 2016-17. The total sales revenue is going to come from your P&L. And same with your cost of sales or cost of goods sold or variable costs. So that's usually your cost of products. You'll put those two numbers in there. It'll tell you what your gross income is. It'll tell you what your gross margin is as a percentage. Then we're going to look at our fixed costs, or our overheads of our business. And they come off the P&L as well. And when we put those numbers in here in the yearly box over there, it's going to calculate our break-even sales. Now what break-even sales means is how much do we need to turn over in a year to cover our costs. Now it's not a target, it's a minimum. And then the spreadsheet calculates, if you look at these, monthly, weekly and daily, it divides by 12 for monthly, divides by 52 for weekly, it divides by 365 for daily. So it's going to help you understand what your break-even sales needs to be on a daily basis, weekly basis, monthly or annual basis. Moving down into the third section down here, we're going to calculate your transaction costs. And what we're doing here is we're going to say, what's the average amount people are spending per order? And you can usually do that by dividing your revenue by the number of invoices that have gone through for the period. And that'll tell you how many transactions you need to do per year, month, week and day to break even. If you measure your leads and you know your conversion rate, you can put that in here as well to actually calculate the number of leads that you require for the period. Now, calculating this number is really just about knowing what it is so that you can tell what my break-even point for my business is. As we move forward, you'll see there's a tab called 5-way goals. 5-way goals is pretty straightforward. If you've seen the 5 ways presentation before, you'll understand that there's 5 areas we can change in the business: leads, conversion rate, number of transactions, average dollar sale, and margin. Now, they're the ones that are in blue once again, actually in 2 areas. So we've got the last year. Now that would be 2015 for this spreadsheet, and this would be 2016. So we do those calculations. Now we start off down the bottom here. Once again, enter values in blue areas, autocomplete in yellow. What I achieved last year and what I will achieve this year. So we could work backwards and we can say we know what our revenue is, we know what our margin is from the first tab, and that'll give us our profits. So we need to plug in things like our average dollar sale. Now up the top here, you'll notice there's 2 areas, to put in customers, because you're going to have existing customers that came from last year, and you're going to have additional customers that you're going to add from new sales. Now once again, it's a model. So you may not get this perfect, but it's going to give us a sense of where we're going to focus on and where we want to do the changes within our business. So these 5-way goals are then going to be replicated, and they're going to be replicated into 5 ways progress, which is over here. And you'll see that it's got targets that have been calculated, and when we look at these targets, you'll notice that it says up the top here 5-way goals. So that's where it's come from. The 5 ways report is where we put the actual figures. Now if you look at this page, it looks a bit small, but let's have a quick look at it. It breaks things down by year, and by month I should say, January to December. It gives us 10 options for where the leads are coming from. It gives us 2 options for conversion rate. Once again, everything has little red triangles to explain what it is. That in some businesses we have 2 conversion rates. It might be conversion rate from inquiry to proposal and conversion rate from proposal to sale. And the overall conversion rate, if we have an 80% conversion to proposal and a 25% conversion to sale, it will combine to give us 20%. Once again, each one of these can be filled out by you: the total transactions, the total number of customers, average number of transactions, all the way through the 5 ways chart. And we should be able to calculate what our net income and our net margin will be historically based on the numbers that were actually measured for that month. Now obviously sounds simple, but the truth of the matter is we have to start measuring a lot of stuff to summarize it into this simple format. So the whole idea here is that we're measuring inquiries, we're measuring number of transactions, and we're working on the 5 areas of our business. This spreadsheet here gives us a simple way of mapping what occurred for the actuals, and that's coming from the 5 O's report, against the target, which is what we stipulated using the 5-way goals model. So nothing has to be changed on this page. All we're really looking for is graphs that are showing us our average dollar sale target versus actual conversion rate, leads generated, etc. Okay, so now that we've understood how we can do our lead generation and our conversion and our number of transactions, we talk a bit about budget. Now, budget is a fairly more in-depth area, but if you look at this, it resembles what your profit and loss is going to be. It's got your sales at the top, cost of sales, materials or contractors, and then it gives you gross profit as a dollar amount, then as a percentage. Overheads down here is basically the expenses that you incur regardless of making a sale. You can add more lines if you wish, but what we want to do is we want to populate this with figures. Well, we can start with historical, so we base it on last year. And what we're using is we're going to use this as a model because a good friend of mine once said it's not about turnover, it's about leftover. So if we look at our total sales here, that might be 100,000 and there's only one column filled out. But our profit margin down here is really what we're looking for, this 74,000. Now, as we populate things into these different tabs, especially the overheads, because a lot of those will be known for us, there'll be things like rent, things like wages, things like entertaining, things like insurances. We can start mapping out what our costs are going to be over the 12 months so we can work out our total overheads over here. Then we need to start plugging in sales based on what we need to do. First of all, to break even, which means to make sure this number is in the black and not in the red. But second of all, to achieve our profit targets. Now, once we've put our original numbers in there, we need to go into a couple of scenarios, and this is where you can copy this budget and you can actually create a conservative and an aggressive budget. But the trick here is to use this tool for modeling. So if you think you're going to employ someone midway through the year, you need to increase wages when you anticipate you're going to employ them, and just watch what happens to the actual profitability, and especially down here, the cumulative profit or the net profit of the organization as we do that. You'll notice down here there's a break even after tab cell, let's call it. And this is the point during the year that your cumulative gross profit equals the predicted annual overhead. Now, the reason we want to know this number is from that day onwards, everything we sell is highly profitable. So that number needs to be under 12 for you to be making a profit. But ideally, we want to get it down to somewhere between 6 and 9 months. Because at that point, it just means after 6 months, every sale we make is highly profitable. And so we're actually starting to accelerate the profitability of the company. Here's a bit of a breakdown of overheads. But the main thing with this budget is that you understand what the model will look like moving forward. The next tab is cash flow. Now, for some businesses, cash flow and budgets are going to be similar because there's no lag, and that's usually companies that work on a cash basis. If you're on accruals, then you're probably going to need to sort of drill in here a little bit more. Now, once again, every red triangle has an explanation as to what it is, and so you can start plugging the numbers into the blue areas. You'll notice that it's picking up sales from the budget, and it's picking up cost of sales from the budget. And what we're doing is if we are adding any cash into the business, or if any cash is coming out of the business, we can adjust it here to make sure that we're telling what the ending cash position is. And this is really about making sure that we've got cash in the bank. Once again, there's an expected cash position based on budget, and there's an actual cash position based on the actuals that we're putting in there. Now, this is an interesting tab here, which is what's known as the profit tracker. And this is where we actually put the true figures in from historical view versus what the budget had stipulated. So if we thought we were going to make 100,000 for June and the actuals were 110, we have a variance of 10, which actually puts us in the black. And you can see that in the graph that sales are exceeding the budget, which is good news. Now, as we project this over a period of time, you'll find that it not necessarily looks so healthy. Well, the truth of the matter is these are all zero until you add the numbers in. So you'll have all your blue bars in here, but then as you get your actuals in, you can see how you're tracking compared to budget. Now, we shouldn't be changing our budget until we have some sort of significant changes within the business. So really, we should be looking to variations here so that we can make things up over the 12-month period. There's also a little tab here, which is other KPIs, and this can be used to do things like measuring target billable hours. But really all it is, it's a way of having a target and an actual, having a variance and converting it into a graph. So that's just a little bit of extra space so that you can put some other KPIs in here. So that's the KPI spreadsheet. In summary, it's a great spreadsheet to get you organised and keep everything in one space. If you need any help with it, make sure you get in touch with your coach. Very useful tool so that we can start modelling your business moving forward. Cheers.